Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So I decided to dress up today. I had a meeting with a potential investor, and then I'm going to do a due diligence trip tonight. So yeah, a lot of things happening. So I figured I'd keep the good looks going. But in today's show, so we're going to do the EIA show, and we want to look at three different parts as usual, but we want to look at the build, because the build was a bit disappointing versus estimates, and it was driven based on a big drop in imports, which we'll talk about, and a big spike in exports. Now, there's also timing delays with all of this, and we want to go through how is that going to adjust into next week, because remember, we talk how it's really important to evaluate the 4-week rolling average and where these trends are really going. Then in the next segment, we're going to focus on the US and do a lot. And in terms of demand continues to underwhelm. And based on what we're seeing, we don't see demand increasing in the next, let's call it week or two, especially as it gets much colder. We have some inclement weather coming through the system. So that's going to just diminish how active people really want to be and what we see going forward. But it should do a little bit of a benefit for the diesel side, but we'll go through those different pieces in segment 2. And then in the last segment, we want to look at for December, where was OPEC versus the quotas, and realistically, how have shipments changed for Russia, which is why we have the nice little joke of ship-to-ship transfers and how they've become so just a bigger advantage for Russian cargoes into the open market. So with that being said, we're going to jump right in and look at where we are coming to this point. So when you look at total oil and product stocks, the surplus narrowed from 21.9 to 13.3. But realistically, when you look at it, you're still fairly normal for this time of year. The question is going to be, how do things adjust as we go into the next couple of months, given the fact that refining activity still remains fairly hindered. Then when you look at total crude stocks, land and floating, the surplus widened from 33 to 33.3. And that was really driven based on a lot of that product was coming from floating storage into onshore storage. So we've seen a sizable increase on the onshore side. And we see that that's going to continue. But with the shifts coming from Russia, we're still going to see a lot of crude on the water. The ship transfers we're going to talk about in segment 3. That's going to, again, keep a lot of these boats active, a lot of this crude between transit and floating. Then you look at total oil product stockpiles, the deficit widened from 11.1 to 20.1, still within the confidence range, obviously on the lower end. And you can see we're tracking seasonal norms. It's just diesel is starting on the lower end. Gasoline, the builds have been fairly lackluster, especially when you look at some in the US versus other places, and a lot of that is just driven based on the differences in shipping. So when you look at diesel, as we were saying, diesel has been flowing aggressively into Europe, but now diesel traders are diverting cargoes of fuel away from the European Union. And a lot of that is 4 vessels hauling about 2.9 million barrels of diesel type fuel, updated their destinations to New York. So again, we're going to see that bigger shift, because PADD 1 still is on the bullish side when you look at storage, more than enough room. This is Russian cargoes, so it'll be, realistically that there shouldn't be a huge issue, just because there is, once it's loaded, those cargoes have a little bit more time, because remember, February 5th is going to be the start of the ban on Russian diesel. But as long as it's on a boat, it should be able to clear customs fairly easy. Then when we look at land storage, here you can see the deficit narrowed from 8.1 to just 1, and you can see that it is right at the 2016 to 2019 and 22 range and average. So fairly normal. You can see that the builds are matching so far in terms of where we are. Not much to say one way or the other. Land storage west of Suez, surplus widened from 3.3 to 8.6. Again, we just see that being fairly consistent, just above that multi-year average, where east of Suez, the deficit narrowed from 11.4 to 9.6. And that's something that's going to continue because we are getting a sizable shift and some additional purchases from China, which is, again, indicating additional flows into the region, which will push some of that a bit higher. And then when you look at the global oil markets, some of the expectations have shifted. There's now a bigger view that there's going to be a bigger surplus in this quarter versus previously expected. And it's really just with demand constrained. The reopening of China has so far been a bit underwhelming, which is, again, for those that have been watching us, is our base case. So nothing is too surprising to us right now. We think that crude prices right now are at the top end of the range. So we think that there is a bit more downside to where prices are. But again, it's not that they're going to go for using Brent from 86 to 68. It's just the matter. It's going to go from 86 to 81, 82. It's just going to be within that range. So then when you look at floating storage, things got a bit more bullish because you had that conversion from floating to onshore. So the surplus narrowed from 28.6 to 21.3, but there's still a very big surplus. Floating storage west of Suez, the deficit narrowed from 3.3 to just 0.5. That's something that is going to come back down because when you look at the U.S. had a fairly sizable increase in floating storage, which will convert and turn into onshore storage, which again is our point about the imports. Imports drop, that should rebound. Exports will slow just because of that timing. Floating storage east of Suez, the surplus narrowed from 22.3 to 15.5. But now that you have more tankers indicating China, we think that that's going to flatline and come back up. And again, be fairly close to where things were in 2022. When you look at crude stocks in the U.S., there was a build of 530,000 barrels. Again, that's 6.8 million above the 5-year average, 32.4 million above the year over year. And you can see that it was driven based on the Midwest and Cushing, where the Midwest is 4.92 million above average. It had a build of 4.92. Cushing had a build of 4.27. So again, when you look at it in general, things are getting a bit normal in those areas against the 5-year. And that's because you had some of the other years falling off. So you have to put it into perspective when you're looking at the 5-year movements, which is why we always look at a broader time frame to make it a bit easier. Pad 3, there was a small draw of 1.96 million. We're still 20.4 million above the 5-year. Pad 5, 2.12, a draw of 2.12 million, bringing us just below the 5-year. But again, still right in line. SPR flat again, as we've seen over this point. So we really are going to see a stop. So we shouldn't see too much. Again, if anything, we should start to see builds. And it's just a matter of timing because remember the first sales were loans with interest. So that will start bringing back some of that crude in general. So now when we look at crude in Pad 3, you can see how we're starting at the highs. We're right where we were in 2017. Only time higher was 2021. We see this coming up, but again, it normally rises this time of year. It's just depending on where you're starting from. So based on what's in floating storage, based on the fairly reduced runs of refining, that will put more product into storage. Cushing, you can see, had a sizable build. When you put it in perspective, it's still starting very low. And when you look at other periods, there are normally builds this time of year. The rate of change is fairly healthy. It'll probably stay fairly strong just because exports are going to stay strong, but a balance at that 3.7, 3.8. Refinery utilization rates are going to be fairly capped, and the imports coming from Pad 2 from Canada into Pad 2 will stay pretty strong. I would say above the 5-year average, which is going to put some of that excess into Cushing. When you look at runs, there was a small increase of 0.8%, but again, it's still very low given historics. And we'll put that in context when you look at the next slide of just where we are versus historics. You can see that the comps get easier, and it's really just driven based on things are slowing down a bit. There's no real impetus to see these bigger increases. They're going to continue to target the distillate side. There's every reason to, just given where storage is, where the refining margins are. But gasoline is okay in the U.S. on a storage front. Prices have started to go up, which should keep us fairly even keeled. And here it's just, we're going to flatline a bit. Realistically, we could go a little bit higher. But you can see we're coming into a normal point where things slow down a bit. And that's again, that seasonal slowdown that normally happens as we go into end of February and then continues through March. And then you start to see those increases as refiners prepare for the summer demand season. When you look at imports, big drop of 956,000 barrels a day. It was driven by Pad 1, Pad 2. You can see it had sizable drops. We do expect Pad 2 to bounce. Pad 2 came down a bit lower than we were expecting. There were some weather issues, but some of that should have passed. So again, it's just going to come back and be just above the 5-year average. Pad 3 continues to be lackluster. We do see it's moving up a bit just because of what's in floating storage versus coming on shore. And then as we said last week, we thought that there was going to be a bit of a bounce in Pad 5. That's timing. So we will get an increase in Pad 5. It's just a matter of when. It didn't happen this week. It will happen next week. When you look at Pad 3, as we were saying last week, we expect it to be below the 5-year average, but a bit off the bottom. We don't see it coming back to the bottom, but staying a little bit elevated but below the 5-year average and really in the middle of this cloud, just because refining isn't running at the normal rate. There's more than enough in storage at this point, but you still need that heavier slate. So you're still going to import, you're going to blend, make sure that you can make the product that's required. So that's where we're going to continue to see that fairly stable. Pad 2, you can see the drop. Seasonally speaking, typically there's a drop at this point. Depth is always going to adjust. So here you can see it overshot to the downside. We expect this to bounce and come closer and just above that 5-year average. Now, when you look at implied demand, small increase in gasoline of 88,000 barrels a day. Again, right around where we're saying, we've been saying about 8.2. Gas buddy was a bit lower, closer to about 8.07. Here you can see that EIA came in at 8.1. So you're still, no matter whose data you use, you are still well below average. And now you have gasoline prices going back up. What's that going to do for the inflation numbers? What's that going to do? And that's why when you look at some of the movements, we don't see a huge change in dynamics when we're looking at underlying demand based on weather, based on, what was the activity in the market, and just what the consumer's doing, what the consumer's not looking to do. And that's where we're going to continue to see gasoline really disappoint. Distillate had a drop of 146,000 barrels a day. Again, you had fairly warm weather. That is now shifting, so you're going to get that bump coming from heating oil. But trucking is still weak, and it's weakening again, coming to the low end of the range that we've highlighted that we'll talk about in the next segment. But again, coming into that problem point. Jet, again, at the low end of our range, we will get a bit of a bounce. Resid, something similar. And then propylene had a drop of 466,000 barrels a day, well below the 5-year. A lot of that is weather driven. You will get some of this recovery coming just because of the heating side. But petchem's still weak. Export's still strong, but petchem's still weak. So still providing an overhang in the U.S. U.S. gasoline implied demand. So typically we get a bounce, and that's what we've been saying. You get a bounce. It normally continues to rally from this point, and it's just what we're seeing based on price, based on activity, based on weather. You're going to have something fairly underwhelming versus the last 10 years, and we see that being fairly consistent. It'll be an upward trend. It's not going to come down to where we were in 2021. It's going to split the difference, and it's going to be a steady increase, but as you can see, very low versus seasonal norms. There's usually a seasonal bump, and it's just we're not going to see that as we come out of January into February, into March. Things are going to continue to be very lackluster. When you look at crude inventories across the U.S., you can see that we're fairly in line. We're right where we were in 2019, just above 2019 numbers. So not much to say one way or the other. You can see that there's a bit of a build. That's normal. So again, we should be building this time of year. So it's fairly stable based on where we are and versus what is normal for this point in time. Commercial oil storage and products. grinding higher as they should. You know, the biggest issue and the difference is gasoline builds in the U.S. have been a bit slower. Distillate draws in the U.S. have been a bit slower. So they net off a bit, but it supports pricing in gasoline. It kind of caps pricing in diesel or distillate. And then when you look at crude, we're going to continue to see those builds really throughout the remainder of not only January, but also into February. Days of supply just because of builds at this point, and then the lackluster or reduced amount of refining activity. We have more than enough crude in based on the days of supply metric. Again, a lot of ways to skin the cat. Gasoline storage, you can see we're building, but you know it's normal versus the 29-year average. But the last couple of years, we've had some sizable builds right out of the gate, and you can see it's fairly slow. We think it's going to be a bit closer to where we were in 2022, where you'll have a bit of a stable build, and it won't be as aggressive as it has been in the past. But draws also won't be as aggressive. So it's going to normalize the peaks and values a bit. So it looks really good right now. But then as draws accelerate in March, we just won't get the biggest draws. And that will make the comps easier, as we say, in terms of just where we should be historically. But right now, pricing is going up. That's going to hinder demand a bit more. That's going to put a bit more gasoline into storage. And whenever the shipping rates allow for it, we will get more imports from Europe. Europe is still flooded with product that can easily be slated to come into the U.S. Distillate, you can see here that normally we get some pretty aggressive draws, and we're just not getting them. And it's really that a lot of that is because of lack of diesel demand for trucking, a fairly warm winter so far in some areas that consume a lot of this distillate. So it's you're starting low, but things are fairly flat. So it's still bullish. You're still in a bullish position versus historics. It's just not as bullish as it was given where we are. So if we see draws accelerate, which they could given historical norms, and is likely given this pivot that we've seen in weather, it's going to be interesting to see how this derives, and if we see some of that increased underlying utilization rates of refining. Jet started on the low end, rising. Again, it's just a balance between jet and distillate. When you look at the curve, you could see that the out months still remain bullish, which was something that we had been talking about, given some of the spreads on the contango side. And you can see that contango still holds firm. Obviously, we've moved up to the top of the range. We think that comes down a bit. But that's just a matter of what's driving today. Is it supply? Is it demand? You know, this morning, demand was a big issue. Then the builds came in a bit lighter than expected, which sent us back to the top of that range. So now when we look at floating storage, you can see that there's been a nice big surge. Historically, there normally is, is this time of year. There's a spike and then a fade. And if you look at imports and exports, it's very likely to see again, that spike, and then you'll see some of these additional imports, and that will help balance things out in general. So that's what we have for you on segment 1. Segment 2, we're going to go deeper into the U.S. markets and the product markets, just to look at where demand is and how things are shaping up for February.